So when I say home building and the real estate market is really what controls the price of these commodities, what do I mean by that? And what I mean is whenever people build a house and a mortgage put on that house, that's new money coming into existence, okay? So from the 1970s, as you can see over here, in the early 2000s, and during some time periods during the early 80s, you see a large increase of new privately owned housing units being built. So they built these housing units, okay? The banks put mortgages against these new homes that are being built, and when the bank issues those mortgages on that house that was created, that's new money coming into existence. And that's essentially what causes inflation. You had a little bit of that during 2022 when, coincidentally enough, oil prices were getting a little bit on the pricey side for the markets. That was just the beginning. That was just the beginning of said housing boom. They increased interest rates like they have never before. It was one of the greatest increases in interest rates in such a short amount of time, which put a heavy load on the housing market. So housing starts consolidating. Right now, I say consolidating because look at 2008. You see how it's like falling off of a cliff? That's not where we're at right now. We're just going sideways. We could go a little longer, a little lower for longer, but eventually I do believe that the housing starts are going to kick back in. And what creates those housing starts to increase in and of themselves are demographics. So demographics come into home buying years, okay? They put new mortgages onto new homes, and that's what creates inflation. And as the volume of those new loans coming into existence increases, inflation increases as well. So yeah, that's essentially the real estate cycle. Pretty general view of it, but that's essentially what the real estate cycle is, and the real estate cycle is what controls these commodities. Because when these new loans come into existence and inflation increases, as the money gets debased, the price of the commodities go up. So the currency becomes worth less, and then the commodities are really just a function of energy and the currencies, so the price must go up. It's too many dollars chasing too few amount of things to purchase with those dollars. But it's really what it really comes down to is too many new currently printed dollars relative to things that actually create the material to create the dollars. Because at the end of the day, real estate, it's not some digital asset. Like you actually have to like use your hands and use materials to build real estate, which gives it some intrinsic value of itself, obviously, because it's also we're humans. We just need a place to live. It's very important to grasp this concept because looking at this, it can give you a really good gauge at where and what cycle you are in the market. So, what cycle would I say we're in the market right now? I would say right now we're in like some type of time period from like either like 1968 or like 1969 or like something like 2001 or 1999, 2000, 2001. We're in those type of like time periods, okay? So like we would be like over here. I think this little pattern right here is a fractal of this pattern right here, okay? That's what I'll say. I don't think we've entered that expansion yet. I think we're in some type of mid-cycle wobble. But whenever housing does begin to do what it does historically with these boom and bust cycles, inflation is going to go up, and oil is going to be one of the biggest beneficiaries. And I mean, the way oil's priced some of these assets, I mean, everything's at all-time highs except for oil. Everything's at all-time highs except for oil. NASDAQ, S&P 500, Dow Jones, silver's pretty close to all-time highs. Gold's been broken all-time highs. It's doing great. Bitcoin's breaking all-time highs. Everything's breaking all-time highs except for oil. Oil's the odd one out, and that's the best time to buy. The best time to buy an asset is whenever it's cheap, and it's the oddball out, and The fundamentals has never been better because all the money's in AI. Well, really, what is AI? Well, AI is really just a derivative of energy. Like, you're really just making electrons go around a semiconductor in a particular type of configuration, and based on that, some math comes out, and the computer looks at the math, and it makes pattern recognition based on the math. It's all essentially, it's a big configuration of energy, is all I'm going to say, of just raw materials. And raw materials and energy and commodities, they're being the left one out in the market, and that's the perfect time you want to be in these assets. You want to be first. You want to be in the party first when it comes to investing. Good afternoon. My name is Xavier. I'm with Daily and Polk, and today we're just going to be going over some chart patterns that I really like. I'm going to give you a little bit about my opinions of the market, and I'll let you come to your own conclusions, and just leave a comment if you have anything to say. So just right off the bat, just looking at the oil market, I think we're really cheap for a couple of reasons. If you price oil relative to essentially any other asset, you end up finding out that oil historically is just dirt cheap. And if it simply mean reverts, you're going to see very large increases in the price of oil. And when I say what do you mean when you say it reverts to its mean? Well, look at over here, okay? I drew a solid line essentially where oil on average ranged throughout essentially from 1956. So let's say the last 100 years. Its average was around 0.7, okay? We're at a 0.2 ratio right now. Lower than we were during some parts of the COVID crisis, and lower than we were during any period back here. We've never seen lower valuations of oil price to gold throughout history ever, point blank period right now. So, if you know that, okay, and let's say there's a chance that inflation can increase like it did during 2022. Remember during 2022 when there was like a little price shocks in oil? Oil was so crazy high. Well, oil wasn't in, it was around that mean, okay? The ratio was 0.6. Okay. During the peaks of some of the ratios, they get up to like 0.15. That means an ounce of gold would be like 15% of an ounce of gold would be the price of oil. So if oil's like at $3,000, 50% of $3,000, it would be like 350 or like 500 or something like that. I'm not too sure what the math is, but it would be a lot higher than where it's at right now. Okay, that's off of like $3,000 gold based off the ratios. Gold's gonna go a lot higher, and if this ratio increases while they're both increasing at the same time, we can see a historic increase of gold relative to essentially all the other assets. Not gold, oil relative to all the other assets, but gold's gonna go up too as well. I've also been looking at silver a lot. Silver's breaking all-time highs. Okay, silver's really cheap. During the 1970s, the early 2000s, and really right now, you see these really large inflections of silver increasing in a really short period of time. And what really causes all of these commodities to do this, it's really the real estate cycle. Okay, it's really the real estate cycle. And what I mean by that is, for every new home that gets a mortgage put on it for a homeowner, that's new money coming into existence. Yeah, my name is Xavier. I'm glad that you watched this video. Leave a sub, comment your thoughts. It could literally be anything. It doesn't even need to be about investing. Actually, yeah, just keep it finance. I just think we're in like a once in a generational opportunity for particular asset classes, and I want everyone to be a part of this. I want to share this knowledge with everyone, and I just want to become a better investor and become more articulate and get more comfortable speaking in front of a camera. And yeah,